Hey folks, this video is going to be about the straight line depreciation method. So we have three depreciation methods that we're going to learn about. I'm going to do a video on each different one. So I'm going to do straight line in this video. I'll do another video on units of output, and the third one will be double declining balance. The basic information I want to use for all examples is that the company is going to purchase a new very fancy copier that does everything but your work for you. So it cost about $110,000. We're going to pretend the salvage value is $10,000, and we're going to think that it's going to last us for 5 years or 20 million copies. That's a lot of copies. Okay, so this is kind of how I'm going to set it up. I'm going to tell you the name of the method we're going to work. I'm going to give you the formula for it. We're going to work it. At the end of that, I'm going to tell you the things to notice. As we're working it, I want you to be able to keep a chart with these column headings on it, because you're going to need each of those numbers for each year for multiple different things. The first thing we're going to do is after we get the depreciation expense on the first year, we're going to make the journal entry to record it, and then we're going to post it to the accumulated depreciation account and get a balance. And then the last thing we'll do for each year is show the financial statement presentation of the copier. Okay, so let's start with straight line. The formula is cost minus salvage value divided by life is going to equal our depreciation expense for that first year. So our cost is 110 minus the salvage value of 10. So our depreciable cost is 100,000. I'm going to divide it by 5 years, and in year 1 our depreciation will be $20,000. So our journal entry will be a debit to depreciation expense and a credit to accumulated depreciation for $20,000. These are considered adjusting journal entries to adjust a prepaid expense back from chapter 3. So when I post, so if it's an adjusting journal entry, the depreciation expense is your income statement account, and your accumulated depreciation is your balance sheet account. So I'm going to post to the balance sheet account. Accumulated depreciation in year 1 is $20,000. I have nothing to add or subtract, so that's the balance. So accumulated depreciation in year 1 is $20,000. If I put it into financial statement presentation, I'm going to show on the face of the balance sheet the copier at cost minus the accumulated depreciation of 20, and that gives me my net book value of 90. If you recall from the definitions, book value is your cost, which is the 110, minus the accumulated depreciation. In this case it was 20, so 110 minus 20 is the 90,000 book value. So everything ties to each other. In year 2 we're going to do exactly the same thing. We use the same formula. Straight line means it's the same amount of depreciation every single year, as long as you're doing it for a whole year. So the adjusting journal entry at the end of year 2 is identical to year 1. Debit depreciation expense, credit accumulated depreciation for the $20,000, which is cost minus salvage divided by life. Post year 2, and now we have a balance at the end of year 2 of $40,000 in our accumulated. Notice that in our chart, my accumulated depreciation at the end of year 2 is 40. Notice that matches the financial statement presentation of cost of 110 minus accumulated of 40 gives us book value of 70, and my book value is 70,000 at the end of year 2, which is cost minus accumulated. Year 3, same process. Depreciation expense is 100,000 divided by 5, which is 20. We're going to make the journal entry next. Year 3, debit depreciation expense, credit accumulated. I'm going to post the accumulated of 20,000, and now my balance is 60,000 in the accumulated depreciation. So I'm going to confirm that 60,000 in my chart Go back to the presentation. In year 3, I have $60,000 for accumulated, and book value is now down to 50. So in year 3, book value is 50,000. I hope you're catching on. Year 4, same formula, 20,000. Cost minus salvage divided by life. Year 4, make your expense journal entry, your adjusting journal entry. Debit depreciation expense for 20, credit accumulated depreciation for 20, post the accumulated, and now your new balance in accumulated depreciation is 80,000. So we've got 80,000 accumulated depreciation, and we have 80,000 accumulated depreciation in our financial statement presentation. And that leaves us with book value of 30, and that's what we have in our chart. Last year, number 5, again, depreciation expense is the same, 20,000. Debit and credit your journal entry for 20. Post the credit of accumulated to the accumulated T account, and now your balance is 100. So notice year 5, the accumulated depreciation balance is 100, and in year 5, the accumulated depreciation you subtract from the cost is 100, leaving you with a book value of 10,000, and we have book value of 10,000. Okay, so here are the things to notice. Notice that the total depreciation at the end of the asset's life is equal to the depreciable cost. So that's this bold number right here. So I've added all 5 years of depreciation. 20,000 times 5 is 100,000. That is the depreciable cost, which is the same as cost minus salvage. Number 2, notice that the accumulated depreciation is the same number, the 100,000. It is equal to the depreciable cost, which is cost minus salvage. Notice that the book value at the end of the asset's life is 10,000, which is equal to the salvage value. And notice that an asset may not be depreciated below salvage value. So if you were to add up your total depreciation expense and it came to 110,000, you've done something wrong. If the accumulated depreciation is 110,000, you've done something wrong. And if book value is not the same as salvage value at the end of the asset's life, you've done something wrong. Okay, straight line method is really easy. Prepare your chart, make your journal entries, post to a T account, fix your financial statement presentation, and then you're good to go with straight line depreciation. I hope this was helpful for you.